Welcome back to China Price Watch. We're talking about how a slowdown in the Eurozone threw the Chinese car market into chaos. As some of the world's most prestigious brands found their European sales down, German and French brands began to give Chinese consumers a second glance. Whereas brands like BMW and Mercedes had previously exclusively targeted China's super rich, the glut of foreign vehicles being shipped to China turned into a boon for the not quite filthy rich. Chinese customs data showed that during the first 3 quarters of this year, China imported 873,000 cars. That's a 22% increase over last year. That increase dramatically outpaced the total growth in car sales of just 3.37%. That's partly because as luxury brands began to flood the market, they encroached on the territory of China's omnivores, the foreign domestic joint ventures. With price cuts of tens of thousands of dollars, certain foreign luxury brands crept towards affordability for China's upper middle classes. As price cuts turned into a price war, some foreign brands even began to cannibalize the sales of their joint venture co-branded cars. The South China Morning Post compared this to ancient Chinese battle strategies where one sacrifices 8,000 troops to kill 10,000 of the enemy. These moves rippled all the way down the food chain, with China's domestic B-class cars slashing their already low prices by tens of thousands of RMB. The price cuts were supposed to clear out fast-growing inventories in China, but the opposite happened. The Financial Times Chinese reports that during the first half of 2012, manufacturers had accumulated 59 days of inventory. That's about double the healthy level of 24 to 36 days. But that average hid an even greater disparity within the market. Whereas joint venture and foreign brands had inventories of 50 and 54 days respectively, domestic Chinese brands had a whopping 94 days of inventories piled up. The only reason they didn't pull the average inventory up higher was that they occupy a marginal space in the market. The China Car Dealers Association reports that of the top 41 best-selling brands, only 7 are domestic Chinese brands. Joint ventures make up the bulk with 23, and 11 are foreign-owned brands. The price cuts were supposed to make a dent in the metastasizing inventories, but the sales boost proved elusive. As China's economy continued to slow, the China Association of Automobile Manufacturers reported that with just 1.61 million vehicles sold in September, the industry saw its first year-on-year decline in sales. But these moderately sluggish sales are a crude average of a highly segmented industry. BMW announced that its sale of 237,000 vehicles in the first 3 quarters surpassed its total from last year. September sales represented a 60% increase over the same month last year. BMW's sales director told the Securities Daily that Europe's slump has turned China into the most attractive market globally. But not everyone is pleased about the developments. Some Chinese officials and industry watchers say the flood of foreign vehicles could cripple budding Chinese automakers. Xu Changming, director of resource development at the State Information Center, said that the surge in imports has severely disrupted the industry. Xu argued that when domestic inventories are already so high, price wars of this kind could hobble domestic manufacturers in their bid for profitability. Having tasted the fruits of both luxury and high-end car markets, it's unlikely that foreign brands will be turning back anytime soon. Domestic car manufacturers are hoping that an uptick in the global economy can take some of the heat off their dwindling market share. But ultimately, they may face a more fundamental question. Can Chinese brands find a way to compete on more than just price? Don't go away, because up next on our question of the day, we'll ask Beijingers for their take on price cuts on foreign luxury brands. Stay tuned.